Welcome to Subramani. I'm going to use two words which you have heard very commonly, the bull market and the bear market, right? Bull market is when everybody wants to buy, everybody thinks the market cannot go down. The economists tell you that the economy is booming, everything is happening great, your exports are rising, your currency is strong, people want to invest in your country, right? Everything is going fine. That is exactly what the media tells you, right? Right now we are hearing all this, and therefore India is poised for another 10 years of growth and will become a 10 trillion economy or a 15 trillion economy. You will hear all those things. That is a bull market, right? Everybody wants to invest. Everybody is asking, can you tell me which share to buy, in which fund should I do an SIP, right? And every CEO is saying, oh, we have reached a particular level, we have reached 10,000 crores, 20,000 crores, 70,000 crores, 1 lakh crores, whatever. So the AUM industry or the mutual fund industry, the PMS, the AIF are all rocking. They're all doing well. The brokerage houses are posting very good profits quarter on quarter. It's a great feeling that it is a bull market, which means it is a bull market. If everybody is bullish about the market, it is a bull market. However, it is time which tells you whether the market was bullish or bearish, because 6 months later, if the Sensex is at 80,000 or say at 70,000, then you see, oh, 67,000 was a great opportunity for me to invest. But if the market is at 63,000, then you say, oh my God, 67,000 is the index at which I should have sold. So first of all, you should not look at the index at all, because most of us who invest in a range of stocks which includes some shares in the index. It can't be, you can't create a portfolio without having shares like HDFC Bank or Larsen and Toubro, State Bank of India, Tata Steel, Unisys, TCS, Infosys, right? You'll have some of these shares in your portfolio. Nobody can build a portfolio without the Reliance, of course. You cannot build a portfolio without these shares. So we will all have, but we will never duplicate the index. You will have mid cap, you will have small cap, you will have all that. So you have to look at what is happening to your portfolio. So if your portfolio is doing well and you have no goal for the next 5, 7, 10, 12 years, then there is really nothing much to be done. Except that if you are feeling good about some fund which is doing very well, or some company share which is doing very well, maybe you remove some part of that money and go and have fun. Let your family feel the benefit of a bull market, right? So maybe you buy a new television, new car, or you add a room to your house, or you go on a vacation, or you buy a camera, whatever, something you want to do, or some small portion. It should not impact your goals, but I'm just saying, removing some money from the market during a bull, when you are feeling bullish, is very good, because you translate that into something that you want to do. Because there is no point at waking up at the age of 70 saying, wow, I did not interrupt my compounding, I've created fantastic wealth, but now I have no clue what to do with the money, right? Don't get into that trap. So if you're 50, 55, you or your kids or your spouse or somebody will have some aspiration which you want to do. This is a great time to be doing that, right? You want to help your children buying a house, do that. You want to buy a bigger house, do that, depending at what stage of life you are. So it's a great time to be removing money from the market, especially for those people who do not have any other goals for 10, 15 years. And if you don't want to do this also, then that's a great time to be in the market, because in the next 10 years again there will be a bust and there will be a boom. You think you can get out during a bull market, keep cash and re-enter when the market is down? That looks very difficult, because you will not know when the turnaround is happening. Like for example, today if the Sensex is at 67,000 and it goes and you sell and it falls to 65,000, you will say, wow, I knew this is going to happen. Then when it goes up from 65 to 68, you will say, no, this is temporary, it can't, because at 67 I knew it is coming down and it came down. But then it goes to 68, 69, 70 and you don't get a chance to enter the market. So don't do that. Don't time the market. If you need money, which is a goal which is 3 years away, it's a great time to be removing money from the market and keeping it in bank FD or ultra short bond fund. Both from a tax point of view mean the same thing, right? That is something which you can do. Now the question to ask is what am I doing, because I thought I will every video I will also say what you should do and what I am doing. I am doing nothing. I have no need for money. I have no need for any capex right now. No big expenses coming, and my current income including dividends etc is more than enough for me to meet all my long term short term goals as of now. So I think I'll go into my pyre without touching much of my portfolio. So 10 years, 20 years, 30 years later, I don't know what will happen, but right now I don't need any money, so therefore I'm not doing anything with my portfolio, whether it is my equity portfolio or my mutual fund portfolio. That brings me to one more thing. Why do I have a mutual fund portfolio? I've done a full video on that, but I have put small amounts of money in many fund schemes, depending if I like the fund house and if I like the theme. I put money. All of them seem to be doing well, including the US is doing well. I didn't expect the US markets to do so well. So the US fund, which is invested in the large the Facebooks of the world, is doing well, and one which has taken a contrarian view, which is more a value stock thing, that is also not done too badly. So I really don't know what I should do with the money, so I have not removed it. I don't have to pay any capital gains tax till I don't remove it. So I really don't know what I'm going to do with the money, but since I don't know, I'm just letting it lie there, whether it is my direct equity or whether it is my mutual fund. However, if you are going to be scared and if you are worried that the market will fall, taking some money out and putting into long bonds is not a bad idea at all. The bond markets are in good shape. You're getting 7.5% kind of return on bond funds, and you can be sure that you will get capital appreciation. So even if you can just postpone the tax by 15 years, let's say you're 45 years of age, or let's say you're 52 years of age, and you know that the next 16, 17 years, 18 years you don't need the money, so you will be in equity. However, let's say you're 75% in equity and you are a little scared because you think some money should be in debt. It's not a call that I'm making, it's a call that you have made. Then putting money in long bonds is not a bad time at all, because I don't think interest rates are going up in a hurry. Interest rates may be here at the same level for some more time. Maybe it's not coming down in a hurry, but I don't think it is going up. So the upside portfolio loss risk because of change in interest rates is now at its minimum. So putting some money into some long bond fund which you will withdraw after 10-15 years is still worth it, simply because you're postponing by your tax by 10-15 years, right? So these are some of the things that you can do, but remember one thing. I'm getting advice, very contrarian advice. One brokerage firm tells me it's a time to be keeping on booking your profits and churning your profits. Remove your profit from fund A, or remove your profit from equity A and buy equity B, or sell equity B and buy equity C, whatever. I think the worst thing that you can do is go down on the quality lane just because the returns are higher. It will look very attractive to buy at those prices. Don't do that, right? I think the weak NBFCs, weak banks are not the place to be in. So whatever you think is good, do one thing, just move a notch up on quality rather than go down on quality, right? Even if you buy some good share today at a high PE, the risk is only in the PE. The risk is not whether the company will be there. So that risk could be there in some of the other companies which could just vanish from the face of earth when the tide turns. So pitching on banking on quality makes sense, because after the fall, as and when the fall happens, at least these companies will survive. Maybe at 80% of the price, or at 50% of the price, it will survive. Some of the other companies which you have not heard of, which are so-called giving great dividend yield, etc., you might be attracted, but you have to see whether that company will be there for a long period of time. So check out on all those things, improve the quality of your portfolio. It's a great time to be selling off shares which you think do not have a future, and don't think they have a future because the price is good. So if you don't know any of those things and you just bought it because somebody else asked you to buy, which means you're riding somebody else's conviction, I think it's a time to get out of all those shares. prune your portfolio. There is no point in having 75 items in your portfolio if you think 55 will do. Get rid of the bottom 20 in terms of value, right? You can do some of these things. Portfolio cleanliness is something to be aimed at in the bull market. Market will definitely come into a bear market because the bull market pressure will push it into the bear market. Today I don't think the Reserve Bank or Fed has the guts to let a 3-year bear market run. So they will do something, they will intervene, and you will be able to sell some of your shares. But please, if you have gone down on the quality, please come back, because in a bull market everything looks good. Then the bear market comes, then you realize that this can't just be sold. Then the next time when the bull market comes, this company is still not in a great shape in the market. These things will happen. Be careful. Thank you.